Hello, in this video, I'd like to help you understand some of the taxes you might pay when you're investing in property. So my name's Simon Zucchi. I'm the author of Property Magic, the Amazon #1 property bestseller. I'm the founder of the Property Investors Network with 50 network meetings around the country. And I've been investing in property for over 25 years. Now, I just need to start by saying I'm not an accountant. I'm not giving you advice here. What I'm trying to do is raise your awareness so you understand some of the taxes that might be involved when you're investing in property. Also, don't let that put you off. The fact you're paying taxes is because you're making money. I sometimes hear people say something crazy like, oh, I don't want to do that. I'm going to make too much money and I'd have too much tax to pay. That's a crazy thing to think. You know, paying tax is a sign that you're making money. And by the way, when you know how to do it, you can actually minimize the amount of tax that you'll pay. I would highly recommend that you find a property tax specialist who can help you with your tax planning, and you speak to them and get individual advice. You should never ever go on Facebook or different forums asking for property help and advice, because it's very dangerous to give general advice because your personal circumstances might mean that that advice is not correct. So you always want to get someone who can give you that advice. But let me give you a few general things to think about. So first of all, when you buy a rental property and you rent it out, the idea is you want to make profit on that property. You want to make what we call cash flow. So when you take the rent each month, you take off the costs like the mortgage, the insurance, the maintenance, maybe the management if someone manages it for you, at the end of the day, there must be some profit left over. That's golden rule number 3 from the 5 golden rules in Property Magic. So there must be profit left over. If there's not profit, don't buy that property. It's not a good investment. And when you know how, it takes just a couple of minutes to work out, is it going to make you cash flow each month or not? So assuming you're buying a property that's making you cash flow, if you own that in your own name, and owning property in your own name always was the best way to do it. I say was before April 2017. You can offset all of the costs, including the management, the maintenance, the insurance, the mortgage. You could offset all the costs against the rental income, and you just pay tax on the profit, okay? Now, the tax you would pay owned in your own name would be income tax, and you'd be taxed at whatever your marginal tax rate is. So if you're a lower rate taxpayer, you'd pay at that rate. If you're a higher rate, you'd pay at that rate, okay? Now, in April 2017, the government introduced something called Section 24. This is where they changed the way that we as property investors are taxed. And what fundamentally it means is you're not allowed to offset all of the interest you pay on your mortgage against your rental income. What that means is on paper, you're making more money. So there are a number of things you can do. Some people have moved. They've got lots of properties, they've moved from their own name to a different structure. Some people are deciding to sell their property and retire early. So a number of different things you can do. If you're investing moving forward, what most people do, but you do need to get advice based on your personal circumstance, what most people do is they put it into a company structure. So they're buying in a company. It's very easy to get mortgages, even if you're completely new to property with no experience. There are lenders who will lend to you as long as the property deal is a good deal. So in the company structure, you're not affected by Section 24, and instead of paying income tax, you pay corporation tax. So it's the tax that you pay on a company's profits. The government will talk about maybe increasing that rate, but at the moment it's lower than you pay as an individual when you're paying income tax. So it's quite good to have a company. And as a company, there are lots of expenses that you can legitimately offset against your property business. So for example, your mobile phone, an element of your travel in your car, these can all be offset through your property business. So having a business is a really good thing to do. And by the way, even if you work for someone else, if you are an employee, it's perfectly fine for you to have a business that you're running part-time in your own time. You could still have a limited company, you're the director, you're the shareholder of the company, that's absolutely fine. So that's income tax. If you sell a property, you will pay, and you own in your own name, you'd pay what's called capital gains tax. So this is the difference between the price you bought the property for. So you might buy it for 100,000 and 15 years later you sell it for 250,000. So you bought it for 100, 250 sales price. The net profit, So the gross profit is £150,000. Now, when you buy, there are some costs. When you sell, there are some costs. And maybe over the time you've owned that property, you've put a new roof on, whatever. You've had a capital cost. All the capital costs can come out of that gross profit to give you the net profit left over. And on the net profit, you pay capital gains tax. Now, the rate varies depending if you're a lower rate taxpayer or a higher rate taxpayer. And each year there's a personal capital gains tax allowance. So in fact, you could sell, and this is, you pay capital gains tax on shares and on property as well. So you could sell some shares or property each year, and the first, at the moment, £12,300 is tax-free. So you have a personal capital gains tax allowance. After you reach that allowance, over and above, you pay capital gains at whatever your normal tax rate is. So that's how capital gains works. If you never sell a property, by the way, you never pay capital gains tax. And what many people used to do, they'd have a property in their own name and they'd keep on remortgages. The value goes up, they'd remortgage the property and they'd take out a lump of money tax-free. Why is it tax-free? Well, it's debt. They could do whatever they want. They might buy some more properties, go on holiday, whatever. Now you've increased the debt and obviously you've got to cover that debt with the rent from the tenants, but it was a great way of working. Now, as I said, most people now move the property into companies, and in a company, again, you can refinance. And if you take a property worth 100, so you buy it for 100 and it's worth 250, and maybe you get a new mortgage for 170, so you get an extra 70,000 in your business, you pay no tax on that because it's debt. Only if you take it out of the business would you then start paying tax on it. So you can use it within the business for genuine business expenses, or you can reinvest the money into other properties. So this is how you build your portfolio. As the value goes up, you refinance, take money out, and you go and buy more. So understanding, should you buy in a personal structure, which if you're only going to have one or two, that might be okay. Most people go for a company structure. And as I said, I recommend you get some good advice. Now, at the end, at the ultimate end for you and the end for me, which is when we die, unfortunately, it's going to happen to all of us, unless they have some sort of cryogenic freezing before it gets to our age, but who knows what's going to happen. And at death, you pay inheritance tax. And inheritance tax is a tax on your net assets. So they'll look at your portfolio, say, right, you've got, let's say, £4 million of property, and you might have £2 million of mortgages. So your net assets might be 2 million, the difference between the mortgages and the value of the property. And on that 2 million, you're going to pay tax. Now you might think, what about the capital growth? Well, when you die, there's no capital gains tax. That's because the rate of capital gains tax is generally lower than inheritance tax. So instead of capital gains, they get you with inheritance tax on all of your assets. Now, there are ways of planning and reducing the value of your estate. And actually, one thing that many people do is they start giving away their assets to their family. You can give as much as you want away every single year. And as long as you live 7 years, that money, that property, whatever it is outside of your estate. Again, you need to get some specialist advice on this to make sure you do it properly. But this is what wealthy people do. You might notice the Times have the rich lists, the top 1,000 rich people every single year. And royalty are often in there. But if you watch a few years ago, you'd see that someone like the Queen Mother, years ago, that they were coming down the scale of top 1,000 richest people because they had all this land and wealth, etc. But they started giving it away to the kids and the grandkids to get it outside there, because even they pay inheritance tax as well. So tax planning is really important. If you want to be a successful investor, it's not just learning how to make money, you want to keep more of the money you make. So I'd really encourage you to go and get some specialist tax advice. If you click on the link below, we have some online training where we talk to an accountant about this kind of thing. That might be a valuable resource for you, so you can go and register for that training. It's completely free of charge. If you like the video, please click on the like. Why not subscribe to the YouTube channel if you haven't done already? Just hit subscribe, press the little bell icon, you'll get notified whenever new videos come out. We have at least one new video every week relating to something to do with property or property related stuff that's going to give you information that's going to help you become a more successful investor. So I highly recommend like the video, then more people will see it. Subscribe. If you want to put a comment below if you like it, just say how much you like it. If you've got a question, please put a question. I can't answer any specific individual tax questions, as I said, because I can't give advice, but if it's general things and clarification you want from the video, really happy to do that. So as ever, I encourage you to invest with knowledge, invest with skill. See you in the next video.